I was pretty much considered a heretic.
Rates were low, plenty of BDCs did very well.
And I got thousands of people saying they sleep better at night.
Selfishly, there's a few that I'm interested in. So if you could just give us your quick take. My approach to income investing has been heavily influenced by Steven Bavaria, and I'm excited to say that he joins us on today's episode. Welcome, Steven.
Thank you. It's a pleasure to be here.
This is surreal for me because I started reading your articles on Seeking Alpha at least 10 years ago, which is a while before I retired in 2017. So very excited to get into this topic with you one-on-one for the first time. And I thought we'd just kick off with a simple introduction. If you could walk us through what it is that the Income Factory does in terms of your approach to investing.
Great, I'll be happy to. I started using the term Income Factory perhaps 6 or 7 years ago, but you're right, I had been writing about it without calling it that on Seeking Alpha for many years as my own investment style morphed into what I now call the Income Factory, and even named my book The Income Factory. When Ford Motor Company builds a manufacturing plant, about a week later, nobody at Ford even thinks about what the plant cost or what its current value is, except maybe the green eyeshade accountants in the back room, because everybody at Ford is focused on how many cars and trucks does it produce? How much output does the factory produce? And I began to realize as time went on that the more I invested with a mindset of thinking about how much income my portfolio, my factory, if you will, my income factory produced, and didn't worry so much about the ups and downs of the value of that portfolio from day to day, week to week, month to month. Although that's what the media wants you to think about, because the media gets its viewers by operating the way ESPN does with sports. The media, CNBC, Bloomberg, and I don't blame them, but they want everybody to be tuned in all day long, worrying about price increases up and down, even though the typical long-term investor is really investing to create an income. I mean, back before we had 401ks and IRAs, people worked at companies for longer, and they would retire on pensions, which were a fixed amount or maybe it would go up over time, like Social Security fortunately does. But you weren't focusing on how much money you had to have invested to create that income stream. The economic value was in the income stream. And so that's what I finally realized. And once I did that, besides calling it the Income Factory, it changed my mindset about what I'm trying to accomplish. The average equity investor who's trying to earn, in theory, the 8, 9, 10%, which has been the historical average equity return over the last 100 years, and that's what we'd all like to earn. But the average equity stock, the S&P 500, for example, has an average yield of 1.5%. So to earn your 8, 9, 10% on average year after year after year, you've got to have capital gains of 7 or 8% in addition to that 1.5% yield. And since you don't get those capital gains every year, you've got some years with -5, some with +10, some with whatever. There's a lot of angst involved especially in the down years. You're collecting 1.5% on your equity portfolio and hoping and waiting and praying, for a capital gain that might not come, or it might even be a negative. So I found the more I started then looking for investments that paid me most of my total return in the form of cash, creating what I now call the river of cash from my income factory, the more I could get 7, 8, 9, 10%, or even more in some markets with higher yielding securities of the kind I own some of. They're not all that high at all. But the more you got it in cash, then you didn't have to worry if your principal never grew at all and you got 8 or 9% in cash year after year after year. That's the same total return as holding an index fund and having it grow at a 8 or 9% average rate over time, but where you're dependent mostly on the capital gains, which are far more volatile than the cash return. So that was the genesis of my income factory as a philosophy and a strategy. And I've written a lot now about both the strategy and philosophy behind it. And then I also write about candidate investments, if you will. I have model portfolios that give different kinds of investors an idea of what they could invest in to have an income factory. But it doesn't mean you have to implement it the way I do. Once you buy into the strategy that, hey, if I invest and get 8, 9, 10% or so in high-yielding investments, then I don't have to worry so much about capital gains. I mean, that's it in a nutshell. And then how you do that and the kinds of asset classes that are eligible candidates for doing that, that becomes a whole other discussion, which, of course, we can get into right now. And I know you have some questions about that.
So we won't have time to go into everything because it's a fairly broad subject, but we will get into some of the nitty-gritty and some specific investments. But if we just stay at the macro for a moment, I've noticed watching some of your other interviews and looking at your portfolios in your investor group, that you tend to weight a little more towards fixed income than equities, whereas most of the financial media is focused on equities, quite frankly. So could you explain to us your thoughts on one versus the other, fixed income versus equities?
Absolutely. In fact, I'm glad you asked about that because most of the investment world thinks of the choice as between equity and fixed income. But if you drill down into fixed income, I actually don't buy and don't really believe in much of what is considered fixed income by most of the investment market and the media. Fixed income meaning investment-grade bonds and treasury bonds has very little credit risk to it. But often it's got a lot of duration risk and interest rate risk because you're investing in fixed rates for long terms. And typically, because there's so little credit risk, because the U.S. government, at least for the moment, can print all the new dollar-denominated debt it wants, so it can always repay its debt. So you don't have any immediate or short-term credit risk with treasuries. And investment-grade bonds, investment-grade very seldom defaults. So you're not paid very much either for investment-grade. So for the last 10, 12 years, you've gotten 2 or 3% maybe for treasuries, an extra percent, 3 or 4% for longer-term investment-grade bonds. That's not much of a return. So what I invest in is credit risk. And when you want to take credit risk, you're talking about high-yield, non-investment grade corporates. Now, non-investment grade scares the heck out of a lot of investors. They say, "Oh, that's so risky," because there were no non-investment grade high yield bonds in the public market until the 1980s. Because all those companies, and the majority of companies out there, are non-investment grade. Even some of the major companies we deal with all the time are non-investment grade, but they had to borrow from banks until Michael Milken invented the high yield market 40 years ago, and they started selling bonds that were non-investment grade. And of course, they got the unfortunate name junk. But these non-investment grade bonds, which you can buy them through closed-end funds. As a retail investor, you can buy them through closed-end funds, some open-end funds, ETFs. But they pay between 7, 8% and 10 and 12%, depending on the structure and the borrower and credit rating. So you can get real payment, real income for taking this kind of credit risk. And when you drill down into the credit risk, you find it's not nearly as scary as many people think. In fact, a lot of investors who own mid-cap stocks, mid-cap funds, or small-cap stocks and small-cap funds, which are, very legitimate equity investments and have done very well over the years. All of those companies are non-investment grade. So anybody who owns a mid-cap fund or a small-cap fund is already taking the risk that those companies will go bust, which is the risk you take when you buy their bonds. But actually the equity investors are taking the additional risk that even though they may not default, they may pay off their debt, but they may do, their performance may be so mediocre that their stock goes nowhere. So if you're buying mid-cap and small-cap funds, you're already taking all the risk and more that you would take buying the kind of high-yield bonds and senior corporate loans that I buy for my income factory. But when I started writing about this for Seeking Alpha 10 years ago or so, I was pretty much considered a heretic and called one, maybe not in that name, but a lot of commenters and other writers would say, oh, that's crazy. You can't have growth unless you have growth stocks. And I said, no, math is math. 10% yields and 0% capital gains is the same total return as 0% yield and 10% capital gains, or 5 and 5, anything in there. And finally, as people tried it, and I got more and more followers, I think I have over 16,000 now, and I'm number 15, I think, in as far as subscription services at Seeking Alpha in terms of numbers of subscribers and all that. So it's become mainstream, fortunately, and I got thousands of people saying they sleep better at night, they're getting the long-term return they're looking for, but they're doing it with less volatility than stocks. But getting people over this hump that, hey, high yield doesn't mean any higher risk than you're already taking with equities, and it's less volatile. That took a while.
I think you could imagine a situation where someone owns equities in a mid-cap business, owns a publicly traded company that doesn't issue investment grade bonds, and that person maybe is fearful of what they call junk bonds, but they own the equity. And so there's an irony in that, because in the capital stack, if things go south with a mid-cap company or any company, the holders of the equity are the ones at the most risk.
Absolutely. In fact, I spent my life in credit. I started as a banker, and then later on, my midlife crisis job, which wasn't such a crisis as it turned out, I became a journalist for a couple of years. Then I went back to work for Standard & Poor's, who do credit ratings, and I actually saw that there was a need for ratings on corporate bank loans, which had never been rated before because banks used to hold their loans on their own books until they matured and they did their own credit rating, did their own credit work. But once loans got so big that banks had to start selling them out to other institutional investors who required ratings. So I sold Standard & Poor's on the idea that they should be rating corporate bank loans as well, and that's how I got into this, and I learned from all that loans, especially, like you can invest in high yield debt in two ways. You can buy senior loan funds, and the loans are at the very top of the capital structure where they're secured. They're also floating rate. The interest rate changes every 3 months generally, so you're taking no interest rate risk, and you've got security so that even if your loan defaults, like if you collect 60 to 70% of your principal back, which is historically what secured lenders have gotten, your actual loss on a defaulted high yield loan, if you will, is only 30 or 40%. If you had defaults at 4%, which would be a very high, that'd be a recession level rate of defaults. There have been some predictors of 4% defaults over the last couple of years by people who thought we were going to have a recession. We haven't had it yet, so default rates have really only been down around 1% or so over the last quite a few years. But even at 4%, if 4% of your loans defaulted, but you only lost 30% on each one, 30% times 4% is 1.2%. So your loss on your portfolio would only be 1.2%. And if you're earning 8, 9, 10% just in interest every year, your 1.2%, that would reduce your earnings, say, to 7% from 8.5% or whatever. But it wouldn't even touch your principal, So, and you imagine the recession that would cause default rates to go up to 4%. Imagine what that would do to an equity portfolio, where your loss would be far more than like 1.2%. So once you start to look at the relative risks of traditional equity versus credit, which I carve out, and I don't call it fixed income because I don't want people to think about long-term bonds and all of that stuff where you don't get paid that much and you're mostly betting on interest rates. But in the credit, corporate credit as an investment asset class has been very predictable, and you can lose money in anything. And there have been some horrible recessions over the years where banks have lost more. But, commercial banks have been doing this, for hundreds of years, and most of them have done pretty well over long periods of time. And that's the kind of investing I'm talking about. But if you do it through closed-end funds, for example, which is the retail investor's way to do this kind of investing, you'd need millions of dollars to buy individual corporate loans or individual high-yield bonds, but you wouldn't want to. You'd only want to buy this stuff in highly diversified pools run by highly professional managers who've been doing it for many years, like Ares and Apollo and Invesco and, people like that. So there are a lot of ways to do it through high-yield, through mutual funds, ETFs, closed-end funds where you can sometimes buy at a discount, which is an additional advantage. It really works. At least, it has for me for years.
Okay.
And most of my readers and subscribers just seem really happy with the results.
Yeah, and I can attest to that because it's working quite well for me too. And actually, I wanted to pick up on something you said. You mentioned, I think it was senior secured loans. So just to explain to the folks watching, you talked about the recovery. Let's say the recovery was 70%, 30% was lost. So what's happening there is that if the loan were to go bad, if the company were to go bankrupt or there was a foreclosure, the loan in that example of senior secured is secured by some sort of asset. So that could be real estate, vehicles, equipment, inventory. It would vary depending on the industry. And then when the loan goes bad, those assets are liquidated, and of course you're probably not going to get 100% of the value of them because it's a fire sale, but you will get cash, and that's distributed. So that's why it's not, in the case of a senior secured loan, a total write-off. Would that be an accurate description?
That's exactly right. Your typical corporate loan, senior loans, as opposed to high-yield bonds, are unsecured debt of a corporation. So high-yield bonds historically have recoveries of only maybe 40%, but there's still a recovery.
So we're talking about high yield, and the yields in the range of 7, 8, 9, 10%, some of them even higher than that. But we're talking about corporate loans, corporate bonds. We're not talking really about the typical publicly traded companies that you see on CNBC, because they tend to yield, if they even have any dividends, something more like 1 or 2% if it's Johnson & Johnson. So when investors see a high yield for a publicly traded company like Walgreens and it shoots up to 9%, often that's referred to as a yield trap. So not all high yield is safe, obviously. Mm-hmm. How do you go about avoiding a yield trap?
Perfect question, because unless you appreciate the difference between a yield trap and a legitimate yield, if you will, you could make a lot of mistakes and lose money in this. As you said, the average S&P 500 company pays a dividend between 1 and 2%. utilities and other companies where you don't expect much in the way of capital gains over time. You expect more of a steady, companies that are well entrenched but are not going to grow like a growth company. They may pay more. They may pay 4 or 5%, and that's okay. And other companies, some of the tobacco companies, which are unpopular for all kinds of reasons among investors, so you have fewer investors considering them. They may be paying, you may see 6 and 7%, and they may be able to sustain that. Or other types of companies that you'll see that might not be as sort of sexy, because they won't have the growth prospects. Some of the communications, some of the telephone companies and everything, you'll see very high yields that are legitimate, I think. But then you'll see companies with really high yields, and you'll think, gee, they normally would only have a yield of 2 or 3%. Usually the high yield is a reflection of the market's expectation that the company's in some kind of trouble and won't be able to sustain that yield for long. So if you see a 9% yield on a corporate, it often means that there's an expectation that it won't be a 9% yield for too long, because they'll reduce the payout. There are credits that are legitimately risky enough that they deserve to pay yields of 8, 9, 10%. But the professionals who assess the credit and decide whether to buy that loan or bond, they've got the experience to know that, yeah, this is a risky deal, but we've structured it so we're protected with security. We know the company well, we've done our homework, and so we're happy to make that loan, but we want to be paid 9 or 10% because that's a legitimate. We've earned that by taking the risk on that. Or that's the difference really between a yield that reflects inordinate risk and a risk of it not being paid or being reduced, and a yield that represents risk, but risk that is being properly structured for and accounted for in putting this deal together. This is why we're seeing, I think, there's been a kind of resurgence recently and a discovery, if you will, by parts of the retail sector of what they call private credit. We've been seeing a real interest in private credit over the last year or so. It means credit that's not structured by banks. It's not underwritten by the commercial banking world. And there's a whole industry out there of mutual funds and insurance companies and professional credit shops. Again, I'll mention Ares, Apollo, Invesco, Prudential, Mass Mutual, which calls itself Barings in the credit market now. But they've been doing what were called private placements 30, 40, 50 years ago for years, where they'd lend directly to companies without a bank being involved. And that kind of credit now is more and more available to retail investors through different funds. So some of the credit investing that you'll see through different mutual funds, closed-end funds, is actually being sponsored by these credit shops that have relationships now with private equity firms.
And you mentioned private credit. Would you include business development companies, BDCs, in that sector?
Yes, I would. And again, business development companies have been doing very well the last couple of years, and I think it's because of the interest in private credit. A business development company is actually it's a non-bank lender to corporates, but they're actually safer in many ways than banks, because a BDC, as they're called, can only leverage itself about 2 to 1, as opposed to the typical bank that's leveraged about 10 to 1. So they're not nearly as leveraged. They do corporate lending, usually secured, and floating rate in most cases, to middle market companies, private companies that might not be big enough, where the deals might not be big enough to interest the banks that do these large syndicated loans that are the kind that show up in mutual funds that do senior loans. And, BDCs they've been a great investment the last few years.
Yeah, they've had a really good run. And actually, I wanted to come back to BDCs, but before we do that and talk about those a little more, I wanted to ask you, just in fairly simple terms, how you go about choosing a new investment. In other words, what your selection criteria are.
Sure. First of all, I should say I don't buy individual stocks, bonds, loans, most of which I couldn't buy as a retail investor anyway, the loans and the bonds. But I only buy through funds because I want professionals managing my money. So I'm evaluating funds essentially from the standpoint of, is it an asset class that I really believe in? And then are the people who are managing it an organization that's been doing it for a long time, is professional, and has a history that demonstrates that at least they know what they're doing and they've been good at it. Basically, what I look at is, first, what kind of fund is it? What do they say their goal is? What's their own investment mission as they define themselves? I mean, that's pretty essential, but it's important because you want to see, if they say they're doing bonds or loans or whatever, you like a little more of a drill down to hear from them what their investment philosophy and approach is, and who the people are who actually manage the fund, how long they've worked there, all the things you would do in evaluating an advisor to manage your money. But then, having seen what they say their plan is, what their mission is as an investment goal, then I look at their history. How have they done? Have they done what they claim to do? Have they done in absolute terms and also in relative terms? I'll look at, if it's a closed-end fund or a BDC, I'll usually go to a site called CEF Data, which is very good. It has up to the minute, like as of yesterday, performance figures, which some of the other sites will have, up to the previous month or something like that. So CEF Data is very good. And so I'll look at how the fund is performed or the BDC over time. So you want to see how it's done relatively to other funds, and they list, where they rank in relation to other funds in that category. So what their performance is, and then how do they earn their total return, which is also very important because, as we said earlier, equity and credit, you make your money in different ways. You can earn your money through interest payments, cash payments, dividend payments, where you're getting the cash in hand, or you can get it through capital gains, which may or may not happen as dependably and predictably as the interest and dividend flow. So I like to see, first of all, if a fund has had a total return of averaging 8% or 9% over the last 5 or 10 years, I'll look at their net investment income. First of all, net investment income is how much of your investment income you get in cash through dividends and interest, minus your expenses of running the fund. So your net investment income tells you what is your income totally irrespective of capital gains or losses. So if I see that a fund is earning 100%, that'd be ideal for a credit fund, or even 80 or 90% of their total return in the form of net investment income, which is cash, basically, then I'll know, okay, they're not particularly dependent on capital gains to pay me the cash income that I can use to compound and reinvest and compound. So that's the first thing I look at. If they're earning most of it in net investment income, to me, I call that unheroic income. In other words, it's income that you get just by, opening the mail, or collecting your dividend and interest checks. So Then I'll look at, okay, if they're not earning most of their income through net investment income, if they're not getting most of their return through that, then it means probably they're an equity fund. And I do buy equity funds, but if it's an equity fund or some kind of a fund that's not earning its regular interest and dividend income enough to create my total return through that cash flow, then I'll want to see, okay, what's its record? If it's dependent on capital gains, but it's been making capital gains solidly for 10, 15, 20 years. Some of these funds have been around for ages, and they're really good. They don't earn it every single year, but most years they do. And so if you see that the total return of a fund for the last 10, 15 years or more has been 8, 9, 10% or more, and they've been getting that, on average for a long period of time, then I'll know, okay, they're probably pretty good at making these whatever capital gains they need to.
So an example of that one, would it be USA, the closed-end fund?
Yeah, some of the fund, USA, I know the symbols more than the formal names on some of them. Some of the Royce funds, Charlie Royce, who's got RVT, Royce Value Trust, it used to be called, it just changed its name, and RMT, I believe. They do small caps, but the Royce funds, they've been doing this for years, with good long-term records. USA and its ASGI, I believe, is its sister fund. There are a number of long-term equity funds that are sold that are closed-end funds, so you can buy them typically at a discount as well, which is a nice feature. Yeah, I'll look at that kind of quality. If they're an equity fund and they're dependent on capital gains, then okay, have they been doing it? And if they have, then I'm more inclined to include them in my portfolio. But they're still only a small portion because I really believe in credit funds, especially right now with all the uncertainties in the U.S. and the world, economically, politically, geopolitically, with wars. I mean, there's so many uncertainties that I like the idea of investing in credit, where you're just betting on the corporate America or the world corporate, the world corporations to just muddle through and survive and pay their debts. So even if stocks tank because of all sorts of macro considerations over the next year, because we don't know what's going to happen. I think credit's a better bet. In fact, but just to finish up, I look at price and discount as well, by the way. After I've decided that this is a fund I like because it's performed and it's got good management, then you look relatively, what's it selling at right now? Is it selling at a discount? Because then if I can get a fund I otherwise like for all kinds of reasons at a 5 or 10% discount, which in the closed-end fund and BDC world you can often do, they sometimes sell at premiums as well, which is why I might like two funds equally well, but if one's at a discount and yielding a little more because it's at a discount than another one, then I'll opt for the one that's at the discount. It's nice to have that option. And then finally, I look at, and a lot of people don't do this, but I like to, I go in and check out what institutional owners own the funds that I'm looking at. I like to invest, not only do I want professionals managing my money, but I like to invest in funds where I see other professional organizations owning the same fund. And you can do that, a lot through your brokerage firm or Yahoo Finance. There are a lot of places that list the holders of other funds. And if you see that there's a lot of institutional interest, a lot of the kinds of institutional investors that manage, high yield, high wealth money. I mean, there are a lot of, you can tell, and you check some of these folks out. You go to their website, and you'll see if they run a lot of family money, the Fisher investment types of the world. If those kinds of people are also investing in these funds, then that just to me is another kind of endorsement.
So you mentioned CEF data as a resource. I've been using CEF Connect. Do you use that one too?
Yes, I do. CEF Connect and CEF Data, they're both good. And CEF Connect is actually owned by...
Nuveen.
Run by Nuveen, which is owned, I think, by TIAA. But Nuveen itself runs a whole lot of mutual funds, and they're very good at it. And they run the CEF Connect site, which is excellent. And it's better for sorting. You can go into CEF Connect and sort by different types of funds and all kinds of different criteria and print out a list of them. So I use them a lot when I look at my model portfolios and I want to sort of sort them out, easily. CEF Data has more up-to-date total return figures than CEF Connect. So sometimes I'll go in and individually cherry pick. It's more work because I can't sort CEF Data as easily, but CEF Data does have more up-to-date total return numbers as of like yesterday. So for some of my analysis, I'll go to that. But if I'm just looking at a whole bunch of funds and comparing them over time, CEF Connect is great. And CEF Connect is totally up to date for things like their yields and discounts, which are very important in making a decision today. Do I want to buy it at this price and this discount? So yeah, they're both great resources, but they have different sort of strengths and weaknesses.
Okay. Well, thanks for that, because I haven't been using CEF Data, but I will check it out for sure. Let's move on to a slightly different topic that we touched on earlier, which is business development companies, or BDCs. They have had a fantastic run over the last couple of years. As interest rates have increased, their profit margins, frankly, have increased, which has been amazing. Some of them, like Capital Southwest, have had returns as like a tech stock, even though they're just a lender. So my question to you is, if the Fed cuts rates, and I realize that's a big if, but let's say they did cut rates, what effect do you think that would have on BDCs?
Well, to the extent that BDCs primarily invest in floating rate senior loans, which is why their assets are high quality. To the extent rates come down, that could hurt their profit margin a bit. However, things don't happen in a vacuum. Rates are not likely to come down unless inflation also is coming down, and the fact that rates come down will actually improve the credit prospects of many of the companies that the BDCs are lending to, because these are companies, they're borrowing at what will then be cheaper prices. Their rates on their loans will come down, which will mean the BDCs will be making a little less money, but the borrowers will be doing a little better because their interest rates won't be quite so high. So there could be some offset if default rates are a little lower because the rates have come down, then that could offset some of the lowering of the margins for the BDCs. But the other answer is, I'm not in this, I'm in this for the longer term. So when I invest in credit, I fully realize that if I'm making 11% rates, as I have been portfolio-wide, and that's because I own some higher-yielding things that we haven't mentioned even yet, like CLOs and certain sort of specialty credit investments. But I'm quite prepared if my average yield drops to 8.5% from 10% or so where it is now. That's fine with me. In other words, my long-term goal is to just earn 8-9%, between 8 and 10%, which is a kind of long-term equity yield type rate. So I don't try to anticipate too much what various asset classes. If I like an asset class like credit, I'm prepared for the fact that there'll be times I'm only going to make 7-8%, and there'll be other times I'll make 11 and 12, and it may average out to 9.
And the impetus for this question is that BDCs have had such a nice run that is the party going to end when the Fed cuts rates? And I think it's worth noting that if you look back in the not too distant past, rates were low, plenty of BDCs did very well during those periods. Maine comes to mind. Maine's history is flawless. So I think if someone's concerned, if rates were to drop 1 percentage point, what would that do? They could look back to a point in history where rates were 1% lower and see where those BDCs were at that time, and many of them were doing quite well. And then the other thing I think is that there's been a lot of special distributions in the last couple of years because the profits were expanded because of the higher interest rates. Those special dividends are not included in the yield that you see on Seeking Alpha or Yahoo Finance or whatever. So I think it's reasonable to assume that those special dividends will shrink or maybe even go away. But the regular distributions, I think, are not going to go away just because the Fed cuts rates by a point or two.
That's a good point. And you're absolutely right that there have been some real solid long-term performers in the BDC world, and it's worth checking them out. And like you mentioned, Maine, Ares is another one, and there are a number of others. Also, just in the last 2 years, Putnam started an ETF called PBDC, and it's an actively managed BDC ETF. So here again, if you and I think it pays a yield of about just under 10%. And there's another ETF in the BDC world. The symbol is BIZD, which has done very well over the years. It's been around longer than the Putnam PBDC, but in the last 2 years that they've both been around, they've both done well. But the Putnam one, the actively managed one, has actually done a little better than BIZD. But both of them are good options, and especially the PBDC because it's actively managed by a guy who's been in this field for 20 years or more. So if you wanted to get into the BDC world and wanted to have somebody else deciding which are the ones like you've just mentioned that are the keepers, no matter what happens, you might want to consider PBDC because then you've got a guy who's making these decisions for you.
I actually looked yesterday at those two exact funds and compared the total returns, and PBDC was 10% ahead of BIZD, which is based on an index. The portfolio manager, Michael, we've exchanged a few emails, and I'm trying to get him on here. So, Michael, if you're watching, feel free to share your wisdom because plenty of people will be interested. And I'm a big fan of the fund. I've invested in it personally. That's great to talk about BDCs. We could talk about those for hours, frankly. But let's move on to the last question because we don't have unlimited time, and I appreciate everything you're sharing with us. I wanted to finish up because I signed up for your investing group and was looking through. You have several portfolios in there, and selfishly, there's a few that I'm interested in. So if you could just give us your quick take, like a minute or two, on 3 funds. Is that okay?
Sure. Test me. Go ahead.
Okay. They're in your core model income factory portfolio. So the first one is fairly new-ish. It's RLTY.
Oh, yeah. That's Cohen and Steers Realty. Yeah. That is fairly new. The realty business and realty funds have taken a real hit over the last few years because they're so interest rate sensitive. When the Fed took rates up, I think they took a hit. It was partly probably psychological. People just assumed that they would do badly, so they sold them, and many of the REITs and other assets they held, in fact, did go down. So I own a number of them, and RLTY is one of them, and they've been coming back. And I'd say that RLTY has been one of the leaders in their coming back. It's a relatively new fund, but Cohen and Steers has years of experience in real estate and other investing, and they've got a number of other funds that have been around forever. But real RLTY is run by the same people and probably holds a lot of the same assets, but it's done very well. It yields 8%, well, about just under 9% I see here. It sells at a discount of almost 8% to its net asset value. And it just declared its dividends out through the end of September, which I always like when a fund declares dividends a few months out. It tells you, hey, we're confident. We think we know where things are headed. And it's been, while it was down over the last few years, generally it's in the past year, its total return was 12%. So 12%, I mean, that's clearly it's on a comeback. If it would make 12% going forward, we'd all be really happy. So 12% for the past year. And for the past 6 months, its total return is 11%, which if annualized would be 22%. Now, I don't think we'd love it if that happened, but I don't think we expect it to keep going at a 22% rate. But the point is it's turned around and it seems to be going at full bore now. It's only 2 years old as a fund, but I think I'm happy with RLTY.
Yeah, sure. I just wanted a quick take, that's all, on a few. So the next one I want to ask you about is XFLT. That's a higher yield.
Oh, yeah. Yeah, that's one of my favorite funds, one of my largest personal holdings, actually. It's in my top 5 or 6. XFLT, that stands for XAI, Octagon, I think, floating rate alternative. It's got one of the longer names. But what it is, it's a fund that buys an assortment of high-yield corporate debt securities of one sort or another. And it actually, I think it yields currently about 14%. And it pretty much, and it covers it. In other words, remember I talked about having net interest income coverage of your distribution. It's got 92% coverage the last time I checked on CEF data, because I was looking at this just the other day because I own a lot of it. And that's really pretty good. It means its current cash income from all of its holdings pays 92% of its distribution. So it's only dependent on capital gains for about an extra 8% of them. And it's had total return of 22%, I see, for the last year on its net asset value, and also on its price. With funds like closed-end funds that you can buy at a discount, you have to look at their total return from 2 different dimensions, based on their market price, but also based on their net asset value. And XFLT does really well on both of those measures. It's earned a total return of 8% over the last 3 years and 5 years, which 8% doesn't sound hugely terrific, but that includes some bad times. That's during the COVID drop. And so to have had a sustained average of 8% for the last 5 years is actually pretty good. And the fact that it's now back up to earning the levels that it is, it earns it because it owns a combination of senior loans, just straight senior loans, plus those CLOs I was mentioning earlier. It owns some CLO equity and some CLO intermediate debt. Put it all together, and it means it's got some higher risk, very high yielding assets in there, plus a whole bunch of solid senior loans, well secured. So you put it all together, and I think it's kind of in the sweet spot of high yield, but not all that risky compared. I mean, you can find some funds that own all equity, all CLO equity, 100%, and they pay dividends of maybe 17 or 18%. to have XFLT paying 14%, but with a blend where only, a third of their balance sheet is that super high risk, and the rest is much more straightforward, predictable, to me is a really good, a really nice blend. Just mention anyone who likes XFLT should consider EIC, which is Eagle Point Income, which is run by the same group that runs Eagle Point Credit. But Eagle Point Credit is all CLO equity and pays a dividend of about 18% currently, I think. EIC is primarily middle-level CLO debt, which is actually very well, it's got a great record, and yet a lot of people are scared of it because it's in a CLO, which they see as very complex and sort of scary. But EIC is another sweet spot yield, in the mid-teens for anyone who's interested.
Okay. I will take a look at EIC. And then the last one I want to ask you about today is ASGI.
Oh, yeah, that's Aberdeen Global Infrastructure. It's one of those utility/infrastructure funds, of which I'm a big believer. I own a number of them. I own, and it's in our core model, of course. I own ASGI, but then also you've got some stalwarts like UTG and UTF have been around for years with great records. ASGI is a little more aggressive than some of the other utility and infrastructure funds, but it's got a good record. It's just younger. It's only 4 years old, but it's paying it, whereas some of the others pay distributions more like in the 8 and 9% category. ASGI is up well over 13%, just I think almost at 14%, and it's at a bigger discount too, I believe. Yeah, it's at a 7.6% discount to earn almost 14%. That's a pretty good combination because the discount gives you a little extra margin of safety. The one thing I'd be concerned a little bit about is that you'd have to watch it closely. I wouldn't take the entire yield and just go out and spend it. No, it's yielding, it's down to 12%, I think, more recently.
The most recent distribution was down slightly from the one before. If memory serves, the distributions are a percentage of the NAV, so the distributions will fluctuate.
Anyway, I mean, it's a very attractive distribution, but you'll have to monitor over time whether it's actually covering all of that. See, Aberdeen generally, they have a reputation for their funds of kind of stretching to pay high yields, and they've done very well at then meeting. You sometimes wonder, are they really going to be able to cover that high a yield? But they seem to do it. But they're kind of, there's not much of a margin there. If they're paying 12% or whatever it currently is, they did earn 16% for the past year in total return. So they've clearly covered it. They're covering it currently. Whether they'll be able to make that kind of return consistently going forward to cover a 12% dividend remains to be seen. So when you're going to play in the part of the market, and I'm in both. My average for my core portfolio, my average distribution is 10.5%. So for every one I've got, like ASGI, that's 12 to 13%, or somebody else that might be 7 or 8%. So you just have to watch your higher ones, to make sure they're continuing to cover it. For people that are taking their cash out and living on it, I would advise, say, only take out 6 or 7% of that and reinvest the rest of it, just to be sure that you're not eroding your capital if they end up cutting their distribution back.
And I agree with you about not spending all of the distributions, especially with these higher yielding ones. By definition, they're going to be riskier than the lower yielders. So you mentioned earlier UTG, which yields more like 8% from memory, has a much longer history. So in a really simplistic way, I would think that huge yield from ASGI, I could imagine trimming some of that off, putting it into UTG for a rainy day, and then if there's a recession and something goes wrong and ASGI were to cut its dividend down to, say, 9%, all that extra distributions that you'd poured into UTG would have grown over time and give you a bit of a margin of safety.
Well, that's right. And in fact, yeah, UTG, they've been around maybe almost 20 years, I think.
Yeah.
They've increased their distribution 12 times over their life. I mean, they haven't for the last year or so, because these have been sort of tough times for utilities, but they're a really solid, and there's also UTF, which is the Cohen-Steers version of UTG, which has a great long-term record. So yeah, I think mixing it up, and having some of each is the way to go, and then reinvesting. What I often say is, with an income factory approach, if you're not obsessing on price, when the prices are down, when market prices are down, and you may have a paper loss that year, but if you're reinvesting your dividends, if you're in a growth mode, if you're not retired, say, and you're still in an accumulative mode, you can, by reinvesting, you're growing your income faster during a downturn than you are during an upswing, because you're reinvesting at bargain prices and higher yields. So, yeah, unless it's a downturn like the 1930s or something that goes on for 15 years, which, I mean, that can always happen. But I don't expect that, frankly. And I think our Fed and everything, we're more sophisticated about how to handle a recession and keep it from turning into a depression than back then. They did the wrong thing, and they actually tightened the federal budget rather than loosened it during the early years of the Depression, and made it far worse than it would have been. But now at least we know more about fiscal policy and everything. So yeah, a downturn can actually help you become wealthier faster if you're in a reinvest compounding mode.
Yeah, for me, one of my goals is to have a portfolio with which I'm indifferent as to whether the market's going up or down. If the market goes up, I could sell something that's delivering a yield that's maybe a little lower than I would have liked when I first bought it. But if the price has gone up, fine, sell some, switch out to something else with a more attractive yield. Okay, so an appreciating market can be good, of course. But then, like you just said, if the market's going through a correction for a year or two and you're still generating income and you can reinvest some of that income at higher yields and lower prices, that's good too. So to be indifferent, I think, mentally, you're just going to be a happier person than being happy when it's green and sad when it's red.
I have so many readers and subscribers who tell me how, it's changed their life as far as sleeping better at night, their whole attitude towards their investments. Like the year we had the big down year, 2022, I think, was a horrible down year in the market.
Yeah.
But my income, because that was a year I didn't have to take much out. I'm retired, so I have to, on my IRA, have a required minimum distribution I have to take out. But even with that, my income increased by 11% during 2022 because of just reinvesting throughout the year. So the fact that the market was down, my income was, which is what I track, was a lot higher at the end of the year than it was in the beginning. So once you're in that mentality, as you mentioned, I mean, life can become a lot more stress-free from an investment point of view anyway.
Well, Steven, we've gone a little bit over time, and I really appreciate your insight. I'm going to put links to your book, The Income Factory, in the description for this episode, and also a link to your investing group on Seeking Alpha. It's called Inside the Income Factory, so those are easy to remember. And if anyone wants to see my portfolio, I'll link to that as well. I really appreciate you taking the time to explain your investment approach.
Well, thank you. And I've really enjoyed it and enjoyed meeting you face to face this way.
Me too. That wraps it up for this discussion with Steven Bavaria about the Income Factory. More Armchair Income coming soon. All right. Yeah, I enjoyed that conversation too. I was going to start yabbering more, and I thought, no, I've got to wrap this up.